Okay, so let's dive into this because just think back maybe, what, 2 months ago. The market was, well, it felt like it was gripped by some serious fear.
Absolutely. We saw some of the biggest outflows of investor money. Well, on record, actually. It felt pretty bleak.
It really did. And now, boom, fast forward to today, June 12th, and the headline we're looking at says stocks are overbought.
Quite the turnaround. And that dramatic swing is really the heart of the analysis we're exploring today. It's from a report by Lucas Downey over at moneyflows.com, specifically his piece from today, June 12th, 2025, called Stocks Are Overbought.
Right. And our goal here, our mission for this deep dive, is really to unpack this specific analysis. We want to get the key arguments about where the market is right now
Uh-huh.
and figure out what's most important for you listening, drawing from their perspective. It's all about making sense of that wild swing from fear to, well, this overbought state.
Exactly. So the report kicks off by taking us back just those couple of months, maybe around April 10th, and it paints a picture of extreme fear really gripping investors. You probably remember that feeling.
Oh, yeah. Lots of negativity, red screens everywhere. It felt like everyone was running for the exits.
That's it. And the source notes those record outflows we mentioned, money was just pouring out.
Okay, so peak fear.
Peak fear. And right then, the source talks about this unconventional idea they had. They were actually expecting, get this, a breathtaking rally.
Seriously, when everyone else is selling.
Yep. They thought a risk-on environment was about to emerge and in short order, as they put it.
Wow, that's quite a contrarian call.
Yeah.
So did it happen? Did this unconventional idea pan out?
Well, according to the report, it didn't disappoint.
Mm.
The S&P 500, starting right from that point of extreme fear,
Yeah.
went on to have one of its best 2-month performances ever in the last 40 years. We're talking roughly a 20% rally.
20%. In just 2 months. Okay, that is breathtaking.
It really is. And the source views this whole rally through the lens of their own tool, the Big Money Index, or BMI.
Ah, the BMI, that tracks the big institutional money, right?
That's the one. And looking at that 20% surge using the BMI, Downey says it shows just how explosive the inflows became. It's their signal that the big money really piled back into stocks after fleeing.
And it wasn't just like a couple of tech giants carrying everything.
No, that's a key point in the report. They emphasize broad-based participation. They saw tons of stocks getting accumulated. That means big investors were buying actively across different sectors.
Okay.
They specifically mention all-star growth names powering higher day after day. So strength across the board.
Got it. But why did that happen? Why such a broad rush back in? Does the report explain that?
It does, and it links it directly back to that period of extreme fear. The source asks, rhetorically, should we be surprised by this level of participation?
And their answer is?
A clear no.
Okay, why not? Why would extreme selling predictably lead to broad buying?
Well, their thinking connects those extreme outflows, like in early April, to what often follows, forced buying. It's almost like a recoil effect. They use their big money phases chart. That's their market cycle model to illustrate this. They say this chart shows that what they call phase 4 destruction.
Which is that intense, fear-driven selling.
Exactly. Those rare periods of really heavy outflows. That phase typically precedes phase 1 FOMO-style rallies.
Ah, FOMO, fear of missing out. So the deep selling creates the conditions for everyone to panic buy on the way back up.
That's the idea. The extreme outflows were like a coiled spring, setting up this explosive broad rally we just saw.
Okay, that makes sense as a dynamic. So that powerful rally leads us right up to the present, June 12th, and the report's main point.
Which is, stocks are overbought.
Right. Stocks are overbought. Now, normally when you hear overbought, your alarm bells might start ringing, right? It sounds like a warning.
It often does, but the source actually pushes back against that immediate reaction. They say, quote, uttering the words overbought conditions may ignite fears of pain ahead, but that's incorrect.
Incorrect. So they're saying overbought doesn't mean sell, sell, sell.
Not necessarily, no. In their view, based on their data, when their BMI hits the red zone, the overbought zone, it tends to stay there for an extended period of time. They use this great analogy that they call it like a bonus round in a video game.
A bonus round. I like that. So you can keep racking up points.
That's exactly the idea. They say portfolios and action characters can rack up a lot of points in the bonus level. You don't want to miss it.
Okay.
So the message is, just because it's overbought doesn't mean the party's over immediately. It can actually be a pretty profitable phase.
That's a really important distinction from the usual take. Does their history support this bonus round idea? How long does it typically last?
Yeah, they provide some historical context. They mention that since 2014, they've had 17 instances where the BMI clocked overbought conditions.
Okay, 17 times.
And looking at those 17 times, the data shows the average overbought stay is 21 trading sessions.
21 trading days. So that's what, about a month, roughly?
Roughly a month, yeah. That's the historical average duration they found.
And what does that imply?
Well, they interpret that duration to mean that under the surface, leaders have plenty of room to run. It basically reinforces that idea that strong stocks can keep performing even while the overall market is technically overbought.
Oh, so hitting overbought isn't the sell signal. It's more like entering a potentially rewarding but ultimately finite phase, historically about a month long.
That's how their analysis frames it.
Okay, so if entering the overbought zone isn't the main danger signal, according to this report, what is the critical thing to watch for? When does the trouble start?
Right, this is the crucial part of their framework. They state very clearly that trouble brews when stocks fall out of overbought conditions.
Ah,
Specifically, the trigger is when their BMI falls below 80%. That 80% level is their threshold for being overbought.
got it. So it's not hitting the high that matters most, it's falling back below that 80% line. That's the warning flag.
That's the signal they focus on, and they back this up. They did a study looking at returns for the S&P 500, the mid-cap 400, and the small-cap 600, and they measured performance starting from the very first day the BMI dips back below that 80% level.
Okay, and what do they find? What happens to stocks after that signal flashes?
Well, they pull out two main conclusions from this study. First, stocks are no match for a falling BMI.
Meaning?
Meaning when their index shows that big money is starting to leave again after being in that overbought bonus round, well, equities have nowhere to go but down.
If the big institutional money heads for the door, the market usually follows. That seems intuitive.
It does. And their second key point is a direct piece of advice. You should prepare for stocks of all sizes to give back gains once that signal hits.
All sizes, so it wasn't just small caps getting hit or...
No, their data showed issues across the board. They specifically reference how large caps, mid caps, and small caps struggle mightily from 1 week to 2 months after the BMI falls out of the red zone.
Wow. Struggle mightily. So we're talking likely negative returns in that period following the signal.
That's what the historical study implies, yes. Significant headwinds across market caps for weeks, even a couple of months, after the BMI drops below 80%.
Okay, let me try and summarize the core message then. It sounds like, enjoy the ride while the BMI is high, in that overbought bonus round which historically lasts around a month. But keep a very close eye out, because the real warning sign is when that BMI drops back below 80%. According to their data, that's when trouble historically starts, and stocks across the board tend to give back gains.
You've got it. That's the pattern their analysis highlights. Ride the wave, but know the specific signal that suggests the wave is cresting and breaking.
All right, so pulling it all together, what's the absolute bottom line from this money flows report, and what's their actionable advice? How should you play it?
The bottom line is super simple and direct. Follow the money flows. That's their mantra.
Okay, and the practical steps.
Also pretty straightforward. First, ride the wave until it crests. Essentially, stay invested, participate in this potential bonus round while the BMI stays above 80%.
Don't jump out just because it feels high.
Right. But, and this is Crucial's account, make sure you have a list of outlier stocks to pick up on any dip.
Be prepared for when the tide does turn.
Exactly. They mention these are the kinds of strong compounders found in our research every week. The idea is know what quality companies you want to buy before the dip happens so you're ready when that BMI signal eventually triggers and potentially creates buying opportunities.
So strategy is capture the upside now, but have your shopping list ready for the potential pullback signaled by the BMI falling below 80.
That sums up their tactical approach. They do wrap up mentioning they're constantly looking for new leading stocks loved by institutions, and they actually sound quite bullish longer term. They state a belief that markets are going to surge a lot higher than the crowd expects, and even hint at another study about why the bull market will keep accelerating.
Interesting. So this BMI signal is more about navigating a potential near-term dip within what they see as a larger ongoing bull market.
It seems that way, yes. It's a framework for managing the immediate cycle based on those institutional money flows. Their final call to action is just money flows, ride it.
Okay, so we've journeyed through this specific analysis, starting from that deep fear just months ago, seeing how the report called for that big rally,
How 20% jump.
then understanding their view of the current overbought state, not as an immediate sell signal, but as this potential bonus round.
Which historically lasts about a month.
And finally, pinpointing their key warning sign, the BMI falling below 80%, which their data suggests precedes a tough period for stocks of all sizes.
Right. We focused on extracting their main points, ride the positive flows, but be ready with your list when their specific indicator signals a likely dip.
And really, this deep dive was about understanding the logic and the data behind this one perspective from moneyflows.com. It gives you a defined way to think about market timing based on their flow analysis.
Absolutely. And that historical data on how long markets stay overbought and what happens after they fall below that threshold adds some concrete, well, context to their strategy.
Okay, so here's a final thought to leave you with based on everything we've just unpacked from this report. Given this specific analysis suggests the biggest immediate risk might actually be missing out on further gains during this bonus round.
Right, potentially staying overbought for a while longer.
But it also gives a very specific trigger, the BMI falling below 80%, as the sign that trouble's likely coming. How do you personally balance that? The report says have your list of stocks ready for the dip after the signal. But thinking about it, historical averages, like that 1-month duration, are just averages. Some bonus rounds might be shorter, some longer. That's true.
So beyond just waiting for that BMI number to drop below 80, what other clues or criteria might you look for, maybe combining this analysis with other things you watch, to get a sense that the crest of this wave is getting close and it's really time to prepare to deploy that dip buying list? How do you gauge when that average month might be running out?